Hello traders, and welcome to my video on the Standard Deviation Indicator, where I'm going to show you how you can use this indicator to help you capture moves like this one for around 400 pips. This is an Australian dollar, US dollar 1 hour chart in the MT4 trading platform. I've attached the Standard Deviation Indicator here below the chart using the default period 20 period. You will probably find the standard deviation indicator on your trading platform. You can use this particular strategy on any trading instrument, that's Forex, crypto, stocks, commodities, indices, etc. And any chart time frame. This is a 1 hour chart. I prefer to use longer term chart time frames simply because they contain more price data and therefore the signals tend to be more reliable from my experience. So I look at the 1 hour, the 4 hour, the daily, the weekly, the monthly. That being said, you can use any chart time frame that you feel comfortable with. In my humble opinion, if I can catch a move like this for almost 400 pips on a 1 hour chart, I'm not sure why I'd want to stress myself out trading 1 minute or 5 minute, even 15-minute charts all day. 1 hour charts also mean less time chart watching. Okay, well, with that being said, how can we use the standard deviation indicator to improve our strategy? Well, this is going to be a trend trading strategy. I'm not looking to try and pick tops and bottoms in ranges. We're going to first look for a trend, okay? So what we do is we mark our resistance level here, okay? Have our support level here, okay? There was an uptrend. So we're looking at the chart from here. Let's say there was an uptrend here. Okay, this is quite a significant uptrend. Okay, so once we reach this resistance here, you can see the resistance has been tested at least 3 times, forming a triple top formation. That shows that it is strong and we could expect a breakout below the support level of the triple top pattern. I do have a video on triple tops you can check out if you want, but basically any resistance that's been touched at least 3 times, which has here. Okay, we draw our support there. I'm going to use the trend line here for support. This is forming a bull trap. A bull trap is basically when there's an uptrend and traders see this and they want to jump in, but they're jumping in too late. And they want to be bulls, but they're late to the party. And then those who were in earlier down here somewhere, let me just zoom out for you. So whoever bought here is going to start looking to take profits around this area. And anyone who's going to jump in here is late. Their stop losses are going to get hit. And you can see from this support line here, from big breakout candle to the downside, exactly what happened. The momentum of stop losses being hit, traders taking profits, caused this downwards momentum. And then we went into a bearish market. Confirmation by the market making lower highs as well. So I have some bearish candlestick patterns. You've got a 3 inside down pattern there. You even have a shorter term level of support there that was breached and actually became resistance here. So all the signs were there for a bearish move. We're not going to look to buy, we're going to look to sell from here on in. Okay, so this is how we would have analyzed the start of this trade. If you are a more aggressive trader, you perhaps could have traded on these original breakouts. I mean, if you did that, you would have been laughing. Let's say you took the first one, you had almost 400 pips of profit potential on this move. You could still even be in the trade with your, I don't know, your stop loss around here somewhere. Just waiting to see how it plays out, and you would have maximized the move as much as possible at this current time. Could have perhaps closed some of the position on the way down. I would have certainly used a trailing stop as price was falling. Had I entered here or here, I'd be moving my stop loss above the recent highs as price falls, just to secure some pips if price decides to turn around. Okay, what you don't want to do is enter here and leave your stop loss up here, because if that does turn around and ends up back here, you've let a big winning trade turn into a, well, either a break even or a losing trade. Okay, so we can catch moves like this, you know, even if what would our stop loss be? Let's say we took that breakout and put our stop loss above the high around 20 pips. I mean, a 20 pip stop loss is nothing really on the 1 hour chart time frame, especially when you can capture moves like this in the space of, what's that, less than a month? Less than a month's worth of trading, you know, almost 400 pips with a 20 pip stop loss, not bad at all. Try getting 400 pips on a 5-minute chart. Good luck with that. Certainly your risk to reward ratio is going to be nothing like like you can have on the higher chart time frames. Okay, not to mention all the false signals, but you do you. So that being said, the standard deviation indicator, where does this come into play? Okay, so first of all, I'm going to just tell you how the indicator works. Forget the complex mathematics behind it. I'm just going to tell you how I see it. Basically, when the standard deviation indicator is high, there's high volatility in the markets and we can expect some big moves, or there are big moves. Don't forget, indicators can be lagging. Sometimes they'll tell you after the fact. Okay, but generally, the higher the standard deviation indicator, the higher the volatility and the bigger the current market moves are. Okay, and on the contrary, the lower the standard deviation indicator, then the less volatile the markets are. And this is when you usually see ranging markets. For example, here, if you can see how low the standard deviation indicator is compared to other times, and the market there is choppy and rangy, perhaps wouldn't be looking to do much in this scenario, unless, as I said, you were range trading and you just drew your resistance, your support, and you're looking to just buy low, sell high, and take advantage of that range. But we're trend trading. The trend is your friend is a mantra that I stick by. I want to be on the side of the market and I want to know which side the market is going. I mean, that's half the battle. Once we see there's a downtrend, why would we buy against it? You know, by going with the trend, we surely increase our probabilities. So that being said, aggressive entry on these early breakouts. Another nice breakout entry there. Even on an angle, you could have got in here. Okay, that support line then becomes resistance. Price falls downwards. In fact, if we take it all the way back, you can see the significance of this level. Okay, it goes as far back as here. Okay, and then that support level, once it's breached, a nice M chart pattern there and a breakout to the downside. Could have even entered on the pullback here or waited for the pullback and entered on the next breakout. There's no coincidence you see these big candles. Okay, see where the support levels are breached? Big candle, big candle. Okay, big candle. Look at this, perfect entry there. Support level, massive candle down. That looks like an NFP non-farms payroll. First Friday of the month candle. We could have rode that momentum. It was probably looking at an angle on this one, a nice wedge pattern. Could have entered on the, that's a descending channel actually, but could have entered on the breakout there. Ample opportunity to get in on this trade. Number one there. Support, support, support. 3 inside down, candlestick pattern, breakout to the downside. Okay, all the way down. Plenty of these opportunities. And we're not even looking at the standard deviation indicator, just to emphasize the fact that with price action and good money management, I mean, you can capture moves like this on any trading instrument, any chart time frame. But if you insist and you like fancy indicators, let's go to the standard deviation then and see what it was telling us. So how I would use the standard deviation in a trending situation like this, I would wait for it to fall low, okay, to make lower lows. The market is losing volatility, it's quietening, which would tell me that there's a pullback. So I know there's a downtrend. I want the indicator to be low, okay, as close to zero as possible, because that tells me there's a pullback. And then as it rises, this is when my entry, I'll be looking for an entry, okay? And you can see that that coincides nicely with the breakout there, because when it went low, we had this range here. We know we're in a downtrend because we've got the lower highs, the lower lows. Okay, we've had a few breakouts. We know it's a bearish market. What we're looking for is a pullback to time our entry. Okay, so this is the pullback here, which the standard deviation indicator shows us by falling and getting lower. Okay, and then as it increases, the trend picks up and we have a move continuation. Okay, then the standard deviation indicator decreases again, which means what? Volatility decreases, the trend slows down, and we go into this range here. You don't need the standard deviation to tell you this. I mean, you can just look at your charts and see that price is stalling, it's consolidating, it's ranging. I mean, you know, it doesn't take a genius or a magic unicorn indicator to tell you that that's a range. Just as you can see that that is a range as well. Price is consolidating. Okay, but the standard deviation, if you prefer visually seeing things presented in that way, I get that. Just as this, the reason the standard deviation indicator shoots up like that is because of that NFP candle there. Okay, that non-farms payroll one. Kind of skews the indicator almost because bar that, it was still a consolidated market, and that's, you know, a rare candle, or the first Friday of the month on NFP day anyway. Standard deviation falls, it's a pullback. Enter on the breakout when it increases. So as it increases, the market's picking up momentum again. Volatility is high. Enter on the breakout. Okay. There will be, you know, if you follow indicators blindly, you're going to miss opportunities. Okay. When the standard deviation is too high, you're not going to really want to trade, just because you can end up selling at the low or buying at the high. Okay. For example, here, you know, you don't really want to sell once after that big candle there. You want to wait for the breakout. Okay. Yeah, and it helps to give you guidance of pullbacks in a trend. Well, that's how I interpret it anyway. You can of course trade it any way you wish, but basically, as things slow down, we look to enter when the momentum picks back up. But the most important thing is we're trading with the overall trend, which still, you know, lower highs. So we're still looking to sell. Okay. It's quiet here. As I said, the lower is the better. So once it's gone low and it starts picking up, we can start to look for a trade, which coincides nicely with this support level here. Big breakout candle to the downside and another entry there. Standard deviation goes low, basically slows down, market starts to consolidate. And what do? Just to reiterate, again, nice M pattern and a breakout, big breakout candle, no coincidence there. Standard deviation starts to increase. We go again. You want to be careful not to sell right at the bottom. Okay, so, you know, I mean, the standard deviation can help in ways to stop you from doing that. When it's high like this, you don't really want to sell. You want to be getting in as low as possible just before the breakout, because if you sell here, you know, you're selling at the low, just as if you sold here when the standard deviation is high, you're selling at the low again. Okay, so wait for the pullback, which is when it's low, and that's when we can time our entries. Get some more examples. It's low here. Okay, so we have either our support like that or like that, and again, big breakout candle. Market still making lower highs. It's not rocket science. Diamond formation as well there. So another good entry. Okay. Yeah, and you could have still you would have been late to the party down here, but there still were moves to be had. I mean, when it's low here, you can see if we just mark that there, breakout to the downside and still pips. But I mean, we want to get in ideally around here early and not exit prematurely. We don't want to get carried away, you know. Say we enter here at the 20 pip stop loss and say, okay, we use a rigid fixed 3-to-1 risk to reward ratio. So after 60 pips, which is where we're around here, we see this big candle, we get excited, we exit our trade. Wow, 60 pips profit, I'm rich. But really, that's leaving too much on the table. Okay, when we get into a good position, we want to maximize the move as much as possible. Okay, that way we can even afford a few stop losses, because we know when a big trade comes, it's going to be worthwhile. Talking of big trades, if we just look at this uptrend now quickly, support level here. Okay, price has reached a support level, higher low, so we're in an uptrend. Okay, what's the, you know, this is a nice uptrend, 300 pips. Again, less than a month's trade in, so you could have been in this one for 300 potential, this one for 400 potential, and using a long-term basic strategy that doesn't require much time at all, 1 hour charts again. So how does it go? Well, you know how it goes already. Standard deviation. Once we've seen this trend forming, we wait for the standard deviation to fall down. That's our pullback. And then as it rises again, we can look to enter. How do we enter? Support or resistance? As we're looking to trade long, because we're in an uptrend, we're going to look for breakout resistance. Any coincidence, there's a big breakout candle there? I don't think so. perfect time to enter in on this trade, this trend. In fact, there's one here. You can see a pullback there in the standard deviation. Pullback's also on the chart. You could have entered in there, and in fact, that level of resistance then becomes support, which emphasizes how relevant it is. It's actually a wedge pattern as well, which gave extra confirmation on the breakout there. You see that angle is like a wedge there. I do have videos on wedge patterns you can check out. Again, so we wait for the pullback of the standard deviation. So around here you can see it's low, market's ranging, not much volatility, and you could look to enter on the breakout. It's a bit messy, this price action around here. Okay, so you might want to wait for that to play out before taking a position. However, if you insist, you can always, it's a bit tricky here where you'd want to do your support, because we did, after have the breakout of that line there, you would have perhaps wanted to wait. Okay, I probably would have waited to wait for a trend continuation after here, because you see there's a lot of consolidation going on. It's not just a pullback and a continuation, it's, you know, almost a flat market. Okay, so we can wait for the breakout again up here, then the pullback. Okay, resistance level, breakout of resistance, resistance then becomes support, and gives you resistance, 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 breakout, resistance becomes support, continuation. Okay, so another opportunity to get in. The standard deviation was low, started to rise. You've got divergence as well to the upside, which shows increase in momentum or volatility. Okay, and then here to this uptrend. So what do we have? Classic standard deviation fell. As it started to rise again and pick back up, we could have entered perhaps based on this probably around here somewhere, almost a W pattern formation there and a breakout to the upside. Also coming off this level of support from here. In fact, that goes all the way back. So that's a strong level. Resistance comes support. So you could have traded the bounce off the support and the breakout there of that short-term resistance. Standard deviation again picking up. But yeah, it just goes to show, just one more. Standard deviation falls, starts to increase again. It's a pullback. Okay. And you can enter again. Big breakout candle, no coincidence. But by now, if we zoom out and look at the overall picture, we risk buying high. Had ample opportunity down and around here to get in on this trend. Okay, but standard deviation, really, to be honest with you, I feel like it's something that you can do by just eyeballing the chart and looking for areas of pullback. I do understand if you're a range trader, it could help you identify ranges, but again, you can just look at the chart and see, okay, that's a choppy market there. The standard deviation is low because there's not much volatility. You know, trade the range. Okay, so hopefully that's given you an idea of how you can implement the standard deviation indicator within your trading. I do prefer myself price action analysis, support and resistance, trend lines, and as always, good money management. Do appreciate you watching. If you could like and subscribe, that would help and be great for the channel. And I hope to catch you on the next one.